would you say?
Well, the last time that stocks like Amazon and Netflix were going wild while oil was getting tortured into the ground was in 1999. It was late in the dot-com bubble. And I would say that the way the misery stocks are being bought and being touted is a definite sell signal.
What are the misery stocks, and what do you mean by that?
Amazon, Clorox, Procter & Gamble, Netflix, Peloton, you name it. The businesses that are benefiting. I heard somebody on the prior show recommend Costco. I mean, is Costco ever going to have a better month than the last 30 days in the history of the company?
And you've liked Costco, yeah.
No. 35 times earnings is what you have to pay to buy that stock.
Right.
So the urge to buy the misery trade in here looking 60 days out, then the opposite side of that is things have gotten bombed out, and there's virtually no hope for numerous areas, including energy. And that's where the opportunities are.
So in other words, Bill, we know your sort of bigger theme has been millennial household formation. They're going to be watching TV. They're going to be going to the grocery store. They're going to be raising kids. Does all of that get delayed? Does all of this change because of the valuations? If a name like Costco might have seemed attractive under that theme before, do you have to throw it out the window because of the extreme trading environment we're in?
Kelly, that's a fantastic question. In 1972, Coke and Disney were trading at 60 and 80 times earnings. They're fantastic companies that did fantastically well, but they got overly popular and were terrible investments for the following 10 years. At the bottom in 1974, Warren Buffett said, and I quote, "I feel like an oversexed man in a harem." He was buying small cap and medium cap stocks that were total bargains because of the decline, but stocks weren't good for another 8 or 9 years after that.
Okay.
And that's the problem is what was already cheap has gone way down, and what was already expensive has got a bid.
So, Mark, let me bring you in on that. Would you be buying some of the bombed out sectors like energy? I wouldn't say financials is quite that bad yet, but it hasn't been great. And do you think we're going to have to wait multiple years for these names to really start to perform?
Well, Kelly, no, I don't think we're going to have to wait multiple years for that to develop. At the same time, I think I'd be a little bit cautious with regard to nibbling at some of these bombed out sectors. There's legitimate reasons for why they've underperformed as badly as they have. At the same time, though, I do happen to think that the massive global stimulus that represents about 20% of the world's GDP that's going to be unleashed economically, fiscally, and monetarily over the next 12 to 18 months or so, in concert with obviously a curing of the coronavirus by way of our healthcare policies and mitigation efforts, will lead to an improved outlook 12 months hence. And so I think particularly some of those industrial sectors, maybe even certainly within the tech sector, some of the beta tech, the semis and so on, look kind of interesting as a barbell to the consumer staples and the healthcare sectors, which I think are still going to see loitering efforts on the part of investors to continue to look for those things that are most predictable in a period that has tremendous uncertainty associated with it.
I mean, the disconnect I hear between the two of you in some ways is time horizon, Mark. If you're looking for things that'll work over the next 6 to 12 months, it's probably not the stuff that could work over the next 6 to 12 years, which goes back to what Buffett was doing in 1974. But let me ask you about the recovery, Mark, that anybody would dare to talk about. What's it going to look like? How much is the help that we've already gotten really going to lead to one? What is the stock? The stock market seems to be signaling a pretty V-shaped rebound. Is that right? Do we need a lot more action in order to make that seem realistic?
Well, I mean, good questions all, Kelly. And, obviously the stock market is a discounting mechanism. Typically, it begins to rally in earnest about 4 months before the end of a recession. So that would have suggested that we would have seen better economic data probably coming as soon as August of this year. And that seems a little unrealistic to me, given obviously the still very strict mitigation efforts, even though some states are adopting some loosening of those protocols here going forward. But nonetheless, I think, therefore, we're going to see kind of a very nuanced recovery. Some industries, due to massive pent-up demand, are going to experience V-shaped recoveries, and others, particularly in travel, leisure, and entertainment, will be more L-shaped in nature. So kind of aggregating those, I come out with kind of a U, where we come out, we get a big bump, I think, initially, but at the same time, though, a more glacial trajectory out going into the back half of this year, and actually a much more robust 2021.
Speaking about glacial, Bill, what if it's an ice age for a little while?
Well, investing is a marathon, and you're right, Kelly. The most success is had in durations of 5 to 10 years, not in 5 months. And when you get in a panic and you get in a huge, the fastest 36% decline in my career, you just want to give up on all that 5 to 10 year stuff. But I'd like to go back to the other guest's point about the amount of money that's been thrown at this. So here's a very interesting thing. That money could very possibly end up being very inflationary. And the sectors that are the most bombed out right now are exactly the industries that historically have benefited from inflationary periods. So in the 1970s, we went from 3% to 11% inflation. The most popular group at the end of the decade were oil stocks. 12 of the 20 largest cap companies in the Fortune 500 in 1981 were oil stocks. Real property becomes extremely valuable in an inflationary environment because they don't make more of it, right? So for example, just use one example, the companies that own the malls, whether you have a JCPenney store sitting on that property or not, it's fantastic property in Los Angeles or Phoenix or very attractive metropolitan areas in the United States. That property will have a lot of value at some point, especially if we get in an inflationary environment.
We got to go, Bill. I want to actually have this as a larger discussion next time. But if there are people who don't believe in the inflationary outcome, would you still say they should invest in energy stocks? In other words, if they think deflation is more likely, should you own energy or not?
Gasoline is automobile cocaine.
You're going to make me think that through. I'm going to need you to explain that out a little bit more for me.